Welcome everyone to another session on Super Trade. Today we will be looking at certain divergences technique, especially we will be focusing on RSI divergence. But before we go into that, now this can be done for a swing trade as well as an intraday trade, but preferably I used to I practice it for the swing trade. Now you have to know, as I've taught you in the previous lessons, that when a stock is in uptrend, it will always make a higher high and a higher low, and when a stock is in downtrend, it will always make a lower high and a lower low. Now, what is, just for a recap, what is a higher high? Let's say, for example, the stock is moving in this manner, in this manner, in this manner. It is making a higher low and a higher high. If I have to draw a trend line over here, you see, if I connect the higher high point, the trend line will show a rising slope, and whether even from the down part is showing a rising slope, which means that the stock is an uptrend. Whereas when a stock is in downtrend, it will make a lower high and a lower low. So for example, here it will make a lower high and a lower low, a lower high and a lower low. It means the stock is in downtrend. So when I connect whether the higher point or the lower point, you'll see a falling slope of the trend line. All right. So I hope you all know this already. Now we try to figure out. It's a lesson with regard to price action that we have covered in the previous two videos. If you have not seen it, please go back and look at the price action video. Where and I'll connect it with RSI for a confirmation. Now, when the price is making a higher high, all right, but the RSI is showing a lower high during the same period of time, during the same length or the duration of the time. It means this, there is a divergence. Because when the price is, the candle is making a higher high, the RSI should also make a higher high, and when the price is making a lower high, the RSI should also make a lower high. All right. So but when there is a divergence, it means the RSI is not agreeing to the price, or price is not agreeing to the RSI. In that case, the RSI will overwhelm the price. It means we will do what the RSI suggests us to do. So for example, if the price is making a lower high but the RSI is making a higher high, it means the price is going to move up. Whereas if suppose the price is making a higher high but the low RSI is making a lower high, then the price is supposed to go down. So we will connect it to the RSI. So this is our RSI. So we'll have to find where is the higher high of the stock is happening and where is the lower high of the stock is happening. So in that case, it becomes really difficult, because it will be a strain on your eye to search where the hell the price is making higher high or a higher low. Say for example, let me show you a place here. So you see here at this point, you can see the price here. If I connect this line, you see from this point, the price has made a higher high, and the RSI has also made a higher high. So there is no divergence here. There is no divergence here. But let me search for one place wherein the price is going against the RSI, or RSI is going against the price. So you'll have to search for it, look for it, where is it happening. So here you can see, now you see if you compare this point here and here, you see the price is making higher high. You see, price is making a higher high. But if I connect the RSI from the same point, you see the RSI is making a lower high. So it means the stock is about to fall. So in that case, what we'll do, we'll simply draw the trend line and wait for the trend line to break, and then we can take a short trade. But in that case, you have to keep scanning through the stock, and there is no scanner that will show you a higher RSI divergence. Most of the scanners, it will show you a kind of a approximation, but not exactly the divergence that is happening. So rather than using RSI, we'll use another indicator, which is nothing but an RSI indicator, but focusing on the divergence. So let me throw away this RSI, and in its place I'll put another indicator, So you simply go to the indicator section and write divergence. All right, write divergence indicator, and you choose this particular divergence indicator. All right. All right. Now this is nothing but an RSI. But now you don't have to look where the price is not agreeing with the RSI. The RSI will tell you where it is happening. So now you see here, you see the price is making a lower low, but RSI is making a higher high. It means the price is about to go up. So what I'll do, whenever this thing is shown here, I'll draw a trend line now. Price action you have to apply. I'll draw a trend line. I'll not blindly take the trade. So the moment I got it here, so I would have drawn the trend line, and the moment the trend line is broken, I'll take the trade. So again you go here. So now you see, now it's showing bear. So why? Because the now the thing is, you have to remember that there should be visible difference. Here there is no visible difference. There is a difference, but little bit of difference is there. All right, here it was a big difference was there. You're right, a big difference was there. So we can ignore those parts. So now again here, uh, not visible difference is here, but here you see visible difference is there. So you see here, when I connect this point from this here, here is the price, and then what is happening here, that RSI is making a lower high. RSI is making a lower high. So, but sorry, higher low. I'm sorry, higher low RSI is making, but the price is making a lower low. Approximately, you say a little bit about it. So what I'll do again, the moment I get the bull here, because if you're trading swing trade, you cannot carry forward the equity is shorting, so you can only carry forward the long trade. So the moment I get the bull here, so you can ignore the bear. So the moment you get the bullish divergence, this is known as bullish divergence. You will again draw a trend line from wherever from the past price is possible. You draw the trend line, and the moment after this the trend line is broken, you can take the trade and see how beautifully the stock has moved up. All right, let me select some other stock. All right, let me select some other stock. All right, Apollo Hospitals now. All right, now it's shown a bullish divergence. So again what I'll do, I will simply draw the trend line from the past price. So when I've drawn the trend line from the past price, you see I have to connect as many points as possible. Divergence is happening over here. All right, so I'll connect these points. So approximately this point. All right, and you see here the price moves up and it gives us some amount of profit. Maybe let's see how much of profit you could have reaped it. If suppose the price is broken down here and would have entered here, you would have gained around 7%, which is not a bad gain in a short period of time. So again we'll keep looking at this divergence. Again you got a bullish divergence here. All right, so again we'll draw a trend line. So again we'll draw a trend line. So whenever this trend line is broken, we'll take the trade. If suppose the trend the price was here, the price went up, and if suppose you would have taken the trade over here when the trend line was broken after the bullish divergence, so you could have carried on. You can take care. You see 29% in, you target 10-12%, that will be more than enough. 10% you could have easily got it here. All right, let me look for another. All right, go for the long trade that you can carry forward in a swing market. And remember, always trade in good stocks, because if you're not trading in good stock and if the price goes down, you will get a panic attack, because good stock will always go up. Now again I got a bullish divergence here. The moment divergence happens, divergence will be seen to you after the price is already, it's a lagging indicator, but we are trying to make it a leading indicator. So bullish divergence has happened here. So again I'll draw the trend line. So let me draw the trend line from the past price movement. You see I've drawn the trend line. The moment after the bullish divergence, the trend line is broken. All right, it may take a day, 2, 3, 4, 5, 10 days it could be, but it will happen eventually. So you could have entered the trade over here when it's broken down. Let's say on 13th of August you would have entered, and you could have got easily 13% in how many days? 13% in around 5 bars, so it means around 8 days, sorry, 8 days you could have got 13%. Alright, now you can say, sir, again bullish divergence is showing here. Alright, but it's not that slopey. But anyways, let's say if you take all the bullish divergence into consideration, so again you can draw a trend line from the past price point and find out where the trend line is broken. If suppose the trend line is broken here and you would have taken the trade, then if you target 5, 6, 7, 8%, if suppose you would have entered at this point when it was broken and the day close happened, then still you would have got around 4, 5%. Now the price eventually came down, but Apollo Hospital is a good stock. You would have continued to hold it. You see, it would have given you 16% over a period of how many? 63 days. That's approximately 2 months. 16% is not a bad deal, right? Let's check some other stock before we uh, wind up the session. Asian Paint. You see, again, search for the bullish divergence. By bullish divergence is seen here. How easy it becomes, because now you don't have to find out where higher high and lower high or lower low and higher low is happening. So bullish divergence has happened here. So again, from the previous price point, we'll draw we'll do the price action. Price action is important. So you see here, the price after the divergence happens on 17th February, and we got a break above the trend line on 2nd May, around about you can say 15 days. So you would have taken a trade over here. How much you would have got? You could have easily reaped a benefit of around 10%. 10% you exit. How many days? Around 36 days. So in a month, a little more than a month time. 60. So now let's take at a bullish. If suppose you want to short the stock, you want to go for a bearish divergence, same thing will be done here. So bearish divergence has happened here. Alright. Now you have to draw the trend line here. So whenever the trend line is broken, you can take the trade. If you are dealing in option, I would not suggest, but you can buy a put option and you see how much you would have got here. If you would have taken the trade here, you would have easily reaped a benefit of around 7-8%. 5% it's more than enough. You can exit in a short period of time. Again bearish divergence happens here. Again bearish divergence happens here. So what I'll again do, I will draw the trend line again. You see, after the bearish divergence happened, the moment bearish divergence happened, I'll come to know over here that bearish divergence has happened. So if I take a trade here, then again, short trade will give you around 10% in a matter of how many days? In a matter of around 34 days. So put options you can buy, but I would not suggest you to go for put option. Always go for cash even because if the stock is sideways and you purchased a option purchase, the theta will always decay. So again you see how wonderful, again you see, bearish divergence, but let's see bullish divergence also happened here. So for bullish divergence, again you draw the trend line from the past. You see, after the bullish divergence has happened, you go to the past price and find out. Sometimes you can draw even a straightforward, clear. So you see, after the bullish, you have got it here. Bullish divergence happened, all right. And even if you would have entered here, it would have given you a lot of trade. Again, bullish divergence happens over here. You see, all right. So the moment it happens, I will draw a trend line. And you see, after the bullish divergence, I have drawn the trend line. So the moment the trend line is broken, I could take the trade, and you see, you could have made how much after this point you would have entered the trade. You would have got around 8% in a matter of 29 days. You would have continued to hold. You would have given 14%, and furthermore, you could have given 18% in a matter of around 3 months. All right. I hope this video is clear to you. If you have any concern, I can repeat in the next lesson about many other divergences, but this is a very powerful indicator. We are mixing the price action with the divergence. Without the price action, do not take any trade, mainly because divergence is happening. So first, divergence is a signal that what is going to happen, and when you combine it with the price action, you're getting the second confirmation, right? So the probability of the trade is very high when you are combining divergence with the price action. So I hope you like the video. Please do like the video. That's what all I ask from you. So if you have any other idea, concern or any other things that you want me to cover, you can put it in the comment box. So we'll meet again. Take care and bye bye.